Interest rates are the cornerstone of every investment decision that we make, both in business and personally. Central banks and policymakers direct decisions that shape the economy. Speculators and market participants attempt to take their views based on understanding of global events and by preempting what they see as the likely outcome. Companies and individuals live with these consequences. I'm Bridget Taylor, and this is Curves and Spreads, where we bring you an insight into the world of rates and further look at how they impact both the short and long-term investment decisions that you make. Today I'm joined by Daniel Laney from Regiments, Eli Changansky from Standard Bank, Bernard Kruger from Clade, and Andre Ehrenstein from RMB. Before we go any further, let's look at the past week's ups and downs. The BOE Governor Mark Carney introduced forward guidance last month, saying that the Monetary Policy Committee won't consider raising its key rate until unemployment falls below 7% in the UK. Yesterday, the ECB held its deposit rate at 0 and marginal lending rates at 1%. Meanwhile, back in the UK, the Bank of England kept its bond purchase target at £375 billion, or $585 billion, and maintained its key rate at 0.5%. Meanwhile, the US Fed's Beige Book indicated that the US economy maintained a modest to moderate pace of expansion from early July right the way through to the end of August. The bank will start to slow its bond purchases at its September meeting, this according to 65% of economists surveyed last month. The survey also indicated that policymakers will end the program known as quantitative easing by June next year, this sparking a global sell-off in bonds, driving yields higher in stressed economies, particularly economies running huge current account deficits. The benchmark 10-year yield touched the highest level in more than 2 years at 2.92% yesterday as impetus gained on tapering expectations. In South Africa, underlying fundamental issues continue to plague the economy and remain a risk to further weakness in both the currency and the yields as foreign flows remain tentative in the bond market. Right, now that we know where we stand for the week, I've got Eli and Dan with me to talk about more strategy on the race markets. Welcome. Quite interesting to see that the National Treasury has been issuing so heavily into the long end. What kind of implications do you think that's going to have with regards to pricing? Because obviously that is where the value lies.
It's certainly where the value lies, and actually the supply has been taken up very well by local investors for the last 3 to 4 months.
For a slightly different view, I've got Bernard and Andre in the studio with me to talk about the strategies going forward for the week. Do you want to give us a view of your curve view? I know that it's slightly different to what Eli and Dan were talking about.
Yes, our view is that the risk, which we are looking at, is actually that the short end of the curve may rise a lot faster than what people are expecting.
And what would your view be?
You can buy from me.
Fantastic. Thank you so much. I really appreciate you coming in this afternoon. Those are our views from Bernard and Andre, and that is the strategy for the coming week. Until next week's Curves and Spreads, enjoy the roller coaster in the fixed income markets.